Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar being brought to us by Ned Davis Research. I'm very pleased to have Ed Clissold, a CFA and Chief U.S. Strategist with the Ned Davis Research Group. We're also very happy to have Rob Anderson, also a CFA and Investment Research Analyst with the Ned Davis Group. So with that, let me put this over on our slide or presentation slides, and we'll go ahead and get underway. Take it away, Rob.
Well, hi. Actually, I was. This is Ed. I'll be taking the first part of it. No worries at all, Cynthia. Thank you very much. Thank you very much, Cynthia, for providing us the opportunity to speak to everybody today, and thank you to everybody for taking the time. This has been, without a doubt, the biggest year in terms of interest and questions and concerns about politics in the markets since we've been covering the elections from an NDR standpoint for the past roughly 30 years. So this seems like a good topic to cover. And for those of you who maybe are a little bit less familiar with Ned Davis Research, I'll give you a quick summary, really from an angle of how we approach this kind of analysis. For us, it all starts with data. We have over 10 million data files in our system. Good data is very hard to get. You can get data from just about anywhere these days, but getting clean data is very hard, and we pride ourselves by having really the best data in the business. And then we have our own software program that we use to analyze the data. So what we do is take a very good historical approach to analyzing any kind of question that comes along, and we're doing that here with the election. So we're not going to get into our political views, what we think should happen, or our own biases. We're going to try to put all that aside and talk to you about what the data says about the election in the markets. And so here in the table of contents, you can see we're going to talk about Trump's reelection bid and how that's shaping up. What a Biden presidency could mean, just because that would be different from Trump, who's been in office, obviously, for almost 4 years. Then some perspectives on the contested elections and some leadership trends. And Rob's going to take it away and talk about sectors, and also looking at not only what sectors could mean going forward, but also what it's saying now about the election. So with that, let's move ahead and start talking about Trump's reelection bid. There we go. Okay, so here's a good example of an NDR chart. What we did is we looked at the performance of the Dow Jones Industrial Average during election years. We use the Dow instead of the S&P because it has more history, but in reality, the trends are very similar. Some of the raw numbers might be a little bit different, but we wouldn't show the data if the S&P and the Dow were telling you something completely different. So what we did is we divided the Dow into 4 different buckets based on who won the election. So you can have an incumbent Republican winning, an incumbent Democrat winning, an incumbent Democrat losing, or an incumbent Republican losing. And as you look on this chart, what you can see is the best scenario for the market historically has been when the incumbent Republican Party has won, and the worst has been when the incumbent Republican Party has lost. Now, so in general, the market has done better when the incumbent wins, whether it's Republican or Democrat. It's just been amplified under Republicans, and it's pretty much because for the last several decades at least, Republicans had tended to run on more of an economic platform, so the market's been a little bit more sensitive to that. Also, you have some pretty big outliers here under the incumbent Republican losing scenario, where 2008, 1932, so that's weighed on that average as well. But that's what the market's facing. So without bringing in all the other possibilities with COVID, earnings, interest rates, et cetera, just looking at the history, it says if Biden were to win, the year-end rally would probably be weaker, and if Trump were to win, the year-end rally would probably be a little bit stronger. And we'll get into a little bit more later as to why it could be that way and what it means for next year. But for now, just keep that in mind. So here is really where Trump's struggles are when you're talking about what he's up against historically. What we've done here is we've looked at election years and said, okay, was there either a recession or a bear market, a 20% decline in the Dow? If you've had either one of those, it's just been tough for the incumbent party. Since 1900, the incumbent party has lost 9 times and won 5 when you've had either recession or a bear. Since 1950, actually incumbents were 0 for 6. So you had to go all the way back to Truman in 1948 with his big upset of Dewey for the incumbent to pull that off. So it's just tough for the incumbent to overcome that. Now, I think this is a key question for this year economically when it comes to the election. Do voters blame Trump? The economy was in very good shape before the COVID crisis hit. The unemployment rate was at its lowest level in 50 years. So do voters blame him for where we are now with a high unemployment rate and a deep recession because he didn't handle the COVID crisis well? Or do they say this is something that came out of the blue and Trump is the best candidate to handle the economy moving forward? Not for us to answer here today, but I think when you're looking at this, how do you handicap this historical trend, which is very much against Trump, versus what could happen? I think that's the key question. So as we move to the next slide, I apologize for jumping this around moving the slides around here. But okay, so here's another economic perspective in regards to the election. Okay, lots of numbers on this table. Just going to focus you on a few of them here. What we do is we look at monetary policy and fiscal policy together. That's kind of giving you what the government is doing in terms of stimulating the economy. So this is our real monetary and fiscal policy index. Just realize that a positive number means the government's stimulating, a negative number means they're taking the stimulus away. And we do it by year of the presidential cycle. And if you look at the averages, well, the most consistent positive stimulus has come in years 3 and 4. That is when the incumbent's trying to get reelected. And so politicians may say, oh, I don't manage the economy to my election, but we have about 50 years worth of data to say they just might do that. And so year 4, the election cycle usually is a pretty good stimulus year, but this is just one for the record books. It's by far the biggest on record. In fact, even bigger than Johnson's Guns and Butter program with welfare reform and the Vietnam War in the 60s. In fact, you had to go all the way back to the 1940s with World War II, where you would get this kind of stimulus from the government. So this has certainly been a big offset and a big reason why the market has recovered so well from the depths of the bear market in March. So this is another thing to think that you could get an offset to that historical trend of incumbents struggling in election years when they get a bear market and a recession. But I think this is a good perspective for just how big the stimulus has been. If it's felt like a big one, that's because it has been a huge stimulus. Okay, so here's another perspective when you're talking about Trump's reelection bid. There were so many polls that were quote unquote wrong on the election, depending on who you looked at, which poll you looked at. They either were saying Clinton was pretty heavily favored to almost a shoo-in. That didn't actually happen. Obviously, Trump won. Well, the market actually got it right. That is, if you look at the performance from the end of the second convention to election day, that's when voters get real serious about who they're going to vote for. And how's that's worked? Well, when the market's been up, the incumbent party has tended to win. In fact, when the incumbent party has won, the Dow has had on average a median of almost 6% rally. When the incumbent party has lost, the market was down about 1.4%. And actually, the market was down a little over 1% in 2016 from the end of the second convention to election day. So right now, the Dow and the S&P are both down about 0.5% since the end of the second convention. So we've still got a little over a week to go. So could go either way, but I think given what's going on with COVID and the importance of COVID with the election, and how that could impact the markets as well, I think this could be an interesting barometer to see how things turn out. Okay, so now we're going to transition over to what a Biden presidency could mean. So this chart hopefully looks familiar. This is a similar chart to what we showed at the very beginning, except for this time we're showing the performance of the Dow in the post-election year. based on who won the year before. So if you recall, the worst scenario for the market has been when the incumbent Republican has lost. Well, the post-election year, the best scenario has been when the incumbent Republican has lost. So the market's been weak early in the year, and then it rallies from there. Now, could be a few reasons for that. One is maybe if there were concerns over higher taxes, increased regulations from a Democrat. Those things generally, don't come to fruition, especially immediately. If there's an economic reason for the incumbent to lose, that can reverse itself naturally. Or maybe the investors just focus on things besides politics, earnings, interest rates, the Fed, things like that, and the market can just do what it's going to do. But for whatever reason, the impact of the election usually doesn't always carry through to the next year. So in reality, I would focus any kind of reaction of the market to the election as one that's more of a sentiment type of reaction rather than some major fundamental shift. If you have a long-term plan for you or your clients, ask yourself if that needs to change based on who's in the White House. Chances are, we're talking about looking out a few decades, the answer is going to be no. But there's just a historical perspective to say that, there's whatever good or bad things happen right around the election, they tend to reverse themselves and even out in the next year. Okay, another big question we've gotten from our clients is not just if Biden were to win, it's what would happen if the Democrats take the Senate as well. So if you recall, the Democrats control the House. So if they were to take control of the Senate, and Biden were to win, then they'd have what they call a Democrat clean sweep. And what does that meant for the market? Well, what this chart shows are inflation-adjusted returns based on the combination of political leadership. So there's 6 different combinations that you can see down here based on the parties in control. So you can have a Democratic president, Republican Congress, Democratic president, split Congress, so House one, Senate the other, and a Democratic president, Democratic Congress. And historically, when there's a Democrat in office, the markets liked it somewhat if there's been some sort of check on power. That if you have Republican Congress or split Congress, the market's done better than if it's all Democrats. So, still, the market's rallied over the long run under a Democratic clean sweep. But I think there's something to say that checks and balances, do matter for the markets, and that's something to consider. Just some perspectives here on what could happen, based on not only the presidency, but what happens in Congress as well. Okay, so one of the things that there have been a lot of questions about when it comes to Biden are taxes. He's put out quite a few tax proposals, hasn't really focused on it in the campaign, but that's been something that he's put out there. One of them is to reverse some of the Trump tax cuts for corporations. So if you recall, in 2018, the corporate tax rate went from 35% to 21%. Biden has proposed to reverse half of that to take it to 28%. So here's a table. Later, if you want to look at the presentation, you can look over the numbers and crunch them yourself and so forth. But just to give you a summary, we started with where we are in 2019 at the 17% effective tax rate. So we call the companies actually pay less than the stated rate. So this shows you, before and after tax earnings. If you take that up to 28%, again, Biden's stated rate, that leads you to about a 13% decline in earnings. But recall, effective rate, stated rate are very different. The effective rate fell 6.6 points between 2017 and 2019. So if we reverse half of that, that gets you to 21%, and that gets you to a 4% decline in earnings. So the devil's in the details when you're talking about tax reform, but 4 to 13% hit to EPS if the tax rate goes up to 28%. Is probably a nice bracket to think about the impact of the market. Now, again, we're skeptical that would happen in 21, considering all the things that Biden's trying to get done. Tax reform may not be top of the list, but that's not for us to say. But next year the expectations are for a huge rebound in earnings as the economy reopens, and so taxes could be a fairly minor impact potentially. If it's only a 4% hit. But again, this is just some perspectives here on what could happen if corporate taxes were reversed. Okay, so another question we've gotten a lot about is what if we don't know who wins on election night? Lots of reasons for that, with an increase in absentee mail-in voting. In some states, particularly in the upper Midwest, aren't going to be counting all of those absentee and mail-in ballots right away. So it's possible we may not know all the states, who's won each state on election night. So, fortunately, there aren't a ton of examples of contested elections, but the obvious biggest one in recent memory is in 2000. This shows a Dow in 2000 from election day to December 12th, when the Supreme Court ruled that the recount in Florida had to end. The Dow had a maximum drawdown on a closing basis of about 5%. So look, it would certainly be a headwind if we didn't know for a while. Now, if it's a situation where a state like Florida, where I live, the mail-in ballots are counted right away, it's quite possible that we'll know who wins on election night. A state like Florida or even Arizona, if both those go for Biden, it might be a little bit clear that he's going to win. If they go for Trump, then those upper Midwest states may be more in play. But 2000 wasn't the only case. 1960 was another example of a very close election. If you recall, Illinois and Texas were close on election night. Nixon gave a vague speech around 3 a.m. where he didn't concede the election. He didn't actually officially concede the election until around 3 o'clock the next afternoon. And the Dow was down about 1.8% intraday, closed up about 0.7%. You have a 2.5% intraday swing. It became clear what was going to happen. There were a lot of Republicans who wanted Nixon to contest the election. They felt that they had a case. He decided not to. Worked out for him 8 years later when he won. So this wasn't the only case in 2000 of a very close election. But if you notice, the market was down for most of the year, rallied going into the election, then a little sentiment adjustment, and then he rallied afterwards. So I think one of the big things is the market doesn't like uncertainty. So once we know who's going to win the election, the market again tends to rally. Either way, a little bit less if the incumbent Republican is lost, but still you do tend to get somewhat of a year-end rally. So a couple more charts here before I turn it over to Rob to go over sectors. So this looks at the relative performance of small caps versus large caps. So this is how the chart looks. This is the historical perspective over 4 years on average. So when this line is going up, the small cap Russell 2000 index is outperforming the Russell 1000 index of large cap stocks. When it's going down, large caps are outperforming. So in an election year, which is the shaded area, small caps tend to outperform, a little bit choppy, but certainly toward the end of the year, you get a pretty good small cap rally. This cycle, it's kind of followed that trend, but not exactly, because of the COVID crisis that really hit smaller companies a lot harder. Since then, small caps have tried to stage that election year rally, but again, it's been kind of choppy. So I think there could be an element of small cap relative strength once we know who the winner of the election is. Probably has more to do with the COVID crisis on the economy reopening than the election, but there is that tendency of a year-end rally, especially in an election year for small caps. Now, shifting over to value versus growth stocks, this is a stronger trend historically, but also one that has not played out at all this year. So in this chart, you have the historical trend. When this line is going up, growth's outperforming. When it's going down, value's outperforming. And then we have this cycle in the bottom section. So historically, value outperforms in an election year. Usually the economy is getting going because you're getting more stimulus to the economy. So cyclical value stocks tend to outperform the more stable growth names. This cycle, it's been the exact opposite, with the economy shut down for a better part of the year. And the stay-at-home stocks, which tend to be the mega cap growth names, have outperformed. So this is really more COVID dependent than the election cycle this time, I would say. So if the economy does look like it's ready to reopen fully, I would expect the cyclical value stocks, which normally do well early in a bull market, early in the economic recovery, they should really outperform. And this cycle implies, what's going on in this cycle versus historically, that these value stocks may be a little bit oversold anyway. So you have that aspect of it as well. But if the second wave of COVID is very pronounced and there's a need for additional stay-at-home orders to some degree, then that could help the stay-at-home stocks, and that would benefit value over growth. So I think this is really more about COVID than the election. And with that, I will pass it over to Rob, who has some great charts on sectors and the elections.
Thanks, Ed. Yeah, so for the second half of the presentation, we'll focus on sector and industry tendencies around the election, and we'll look at some policy proposals from the candidates and their potential impacts. So the first chart here, we're looking at our broad cyclical sector index versus our defensive sector index. Our cyclical index is made up of the industrials, discretionary, materials, technology, and financial sectors. The defensive index is staples, healthcare, utilities, and telecom services. So the orange line on the chart represents the average of cases when the incumbent party loses the election. Blue is the average cases. The average cases when the incumbent party wins the election. And what the chart is showing is that regardless of election outcome, you tend to get more defensive sector leadership prior to the election and immediately following the election, as you get that election uncertainty get priced into the market. But post-election, you tend to see the trends reverse if the incumbent party loses the election. So the orange line here is the average of the incumbent party losing the election. You get strong defensive leadership, but post-election, on average, you'll see cyclicals outperform. And that's not true when the incumbent party wins the election. In those cases, you tend to get more defensive leadership after the election. The next slide here, we can look at those leadership trends in a little bit more detail. There it is. Okay, so this chart here, we're looking at the median relative sector performance 6 months after the election, based on whether the incumbent party wins or loses the election. So the blue bars are cases when the incumbent party wins. The orange bars are cases when the incumbent party loses. And we're looking at relative return. So a bar going up means the sector has outperformed the S&P 500. Down means that it's underperformed the S&P 500. And if you look at the orange bars on the chart, you'll see that communication services, financials, and discretionary, they tend to perform best when the incumbent party loses. So those are more cyclical sectors. And when the incumbent party wins, you get more outperformance from healthcare and consumer staples, defensive sectors, and you'll see a lot of weakness from technology and discretionary in those cases. One theory for why returns tend to break down this way is that the incumbent party is more likely to lose the election when the economy is weak prior to the election. So post-election, you get the economy, you see the economy improve, and that in that scenario, cyclical sectors will tend to be favored by investors over defensive sectors. So this next chart here is the same as the previous one, except now we're looking at returns 12 months after the election. So the trends have been similar. You get more cyclical leadership when the incumbent party loses. But the interesting thing about this chart is healthcare's performance. So healthcare is often a sector that gets caught up in election year politics. Healthcare reform, lower drug prices are often talked about during the campaign by both parties. And what has tended to happen is that the sector has been the best performer 12 months after the election when the incumbent party wins the election, and the worst performer when the incumbent party loses the election. So we'll talk a little bit more about healthcare later, but it has tended to benefit more from the status quo of the incumbent party winning more than any other sector. So this chart is similar to the previous two, except now we're looking at returns 12 months after the election based on which party has won the election. And what it shows is that you get more cyclical leadership the year after the election under Democratic presidents and more defensive leadership under Republican presidents. So the orange bars on the chart, you'll see communication services and technology, they've done best under these Democratic presidents, while the blue bars show that consumer staples and healthcare have performed best under Republicans. And one explanation for why returns break down this way is that the market has tended to do best post-election when the incumbent party loses the election. And we showed this on slide 5 of the presentation. And that has tended to translate into more cyclical leadership under Democratic presidents during the first year. So if we put this message that the chart is giving with the previous two, we see that the market has seen more cyclical leadership post-election when the incumbent party loses, and more cyclical leadership when the Democratic candidate wins. So both studies point to the possibility of more cyclical leadership under the first year of a Biden presidency and more defensive leadership if Trump were to win re-election. Now, of course, there's other factors that come into play that impact sector leadership trends, but that seems to be the message from these two studies at least. So for the next few slides, we'll look at policy proposals from the candidates. And one of the biggest issues, at least from a market perspective, is taxes. Like Ed mentioned earlier, Biden's tax plan calls for a tax hike. He would raise the corporate tax rate from where it is now, 21% to 28%. And to get an idea of how a Biden tax hike could impact sectors, what this chart is looking at is the impact sectors had from the Trump tax cut. So the blue bars show the median effective tax rate at year-end 2017 before the cut went into effect, and the orange bars are looking at year-end 2019 rates that reflect the Trump tax cut. And the implication for sectors is that the sectors that saw the biggest benefit from the Trump tax cut could be most hurt from the hike. So those sectors include communication services, utilities, financials, and discretionary. They saw the biggest benefit from the Trump cut. They saw a 9 percentage point drop or more in their median effective tax rate. And on the flip side, materials, technology, and energy all saw less than a 5 percentage point decline and would likely be less relatively impacted by a Biden tax hike. So switching over to healthcare now, Joe Biden's healthcare plan calls for an expansion of the Affordable Care Act with the goal of ensuring 97% of Americans. Currently, that number is about 91%, so his goal is to raise that number about 6 percentage points. And more healthcare insured has typically been a positive for the healthcare sector, and specifically the managed care sub-industry. So what this chart is looking at is the percent uninsured rate versus managed healthcare relative strength around the Obama presidency. Excuse me. So the orange line is the percent uninsured, and the blue line is managed healthcare relative strength. And what happened during the Obama presidency is that managed healthcare outperformed as the uninsured rate fell. And actually, out of the 158 GICS sub-industries, managed healthcare was the best performer from the end of 2010, when the uninsured rate peaked at 15.5%, through 2016, when the rate troughed at about 8.6%. So the possibility of more healthcare insured under a Biden presidency should be a positive for the healthcare sector and for the managed care sub-industry. Offsetting some of the optimism of more healthcare insured is Biden's plan for a Medicare-like public option. That plan would be administered by the government and would compete directly with the private insurers. So that plan probably wouldn't get much support by Republicans, but if we do end up with a blue wave in November, that public option could become a reality and would probably offset some of the benefit of more healthcare insured for the sector. So another big issue this year is infrastructure. Trump has talked about spending between 1 and 1.5 trillion on infrastructure. Biden's plan calls for a $2 trillion investment in infrastructure, which would go towards highways, transit, water, green energy, and broadband infrastructure. Both plans would likely be bullish for the industrial sector and especially bullish for the capital goods industry, which makes up about 65% of industrial's market cap. So the chart on this slide, we're looking at the largest sub-industry in the industrial sector, which is the machinery sub-industry. And we're looking at the machinery sub-industry's relative strength versus government structure spending. So when structure spending by the government has been high, or 2% or more of GDP, machinery has tended to outperform the broader market by about 14% per year. Other sub-industries like the electrical equipment, industrial conglomerates, and building products, they've also been very sensitive to government structure spending and have all outperformed when structure spending has been high. So when looking for potential areas that could benefit from infrastructure investment, we would start with the industrial sector. So another important issue is energy. And if you watched the debate last week, you probably noticed at the end there was a heated exchange between Biden and Trump over the future of the oil industry. Biden's energy plan calls for more regulation. So he wants to limit pipelines, freeze public land fracking, and put a moratorium on offshore drilling. These proposals should lead to a continuation of the clean energy over traditional energy trade if Biden were to win the election. The chart on this slide shows our clean energy basket, which is equal weighted 10 energy companies versus our E&P basket, which is equal weighted 10 E&P companies. And it looks like the market's already pricing in a Biden win. But if it does materialize, we think that the clean energy trade should have room to continue to run. A Trump reelection, on the other hand, would probably be better for traditional energy. But we think even a Trump loss could present some opportunities in the traditional energy space. All of Biden's regulations would likely limit U.S. oil supply and could lead to higher oil prices that could benefit traditional oil companies with significant international exposure and less exposure to underdeveloped U.S. land. So for these last two charts, we'll compare the current market action to some sectors to previous election cycles to get an idea of market expectations for the election outcome. So the first chart here, we're looking at healthcare's relative 2020 performance compared to previous election years. So as we kind of mentioned earlier, healthcare has preferred the status quo of the incumbent party winning the election. And historically, in cases when the incumbent party has lost the election, you have seen healthcare underperform the market in the second half of the year. And you can see that in the chart with the orange line as it kind of goes down in the second half of the year on average when the incumbent party loses the election. When the incumbent party wins the election, you've seen the opposite. You've seen the sector outperform in the second half of the year. And that's the dark blue line at the bottom of the chart. So if you look at the dashed blue line, that represents 2020 healthcare's performance, which has been weak since May. It's been underperforming since May, and it looks like it's closely aligned with the incumbent party losing the election. So this chart here would probably point more towards a Biden victory over Trump. So the final chart here shows our Democrat positive impact index. So we had some client questions that asked about areas of the market that could benefit from a Biden presidency. So we put together this equal weighted index that's comprised of 15 stocks from the pollution control services, clean energy, building products, and managed healthcare industries. And the bottom clip of the chart is showing the basket's relative performance versus the S&P 500. And as you can see, the group has been very strong since really the end of the first debate when Biden expanded his lead over Trump. So this is another one of our charts that would seem to favor Biden over Trump. So the bottom line, it's difficult for the incumbent party to win elections with election year recessions and bear markets. The question is whether voters blame Trump or not. Investors' biggest fear about a Democratic sweep is that it will likely lead to higher taxes. Election year uncertainty tends to reverse post-election year as investors begin to focus on other market factors. Value and small cap stock performance may be more dependent on the economy rather than election tendencies. Cyclical over defensive sector leadership has been more common following incumbent party losses and under Democratic presidents. Managed healthcare, capital goods, and clean energy could benefit more from a Biden win, while defense and traditional energy would likely fare better under Trump. And with that, that concludes our prepared remarks, and we can now move to the Q&A portion of the call.
At this point, I'm going to jump in here because I want to thank both Ed and Rob for the presentation. And if you do have any questions, keep in mind there's a questions panel located over on the right-hand side of your screen, and where you can enter any questions that you might have at this point. What I'd also like to point out right now is that if you do want a copy of the slides, there's a handouts pane that's available over on the right-hand side of your screen that will allow you to, you'll see a PDF copy, and you can download a copy of today's presentation directly from here. Now, before I do pass this back over for our questions, what I do want to do is bring up the Trader Workstation. Now, notice I've brought up TWS, and Interactive Broker clients will recognize that we're looking at the Mosaic interface. Now, notice if you do want to access any of the Ned Davis research products that we have available, go to the new window button here where you can access analyst research. Now, you'll notice excuse me. Notice here, the NDR advisory publications are available to all our clients through the Trader Workstation. So simply access this information. You'll see that, notice here, there is a drop-down list of the different reports that are available and accessible by date. If you're looking for a particular ticker symbol, notice there's even a search field that's included in this window that will give you access to those NDR research reports. So quickly wanted to show you that not only today's presentation, but the Ned Davis research reports are available to IB clients here. So with that, I'm going to turn this back over. I see questions have been coming in. So I'm going to turn this back over to both Ed and Rob to handle those questions. So let's put this back over on your slides, and we'll get back to those questions. Go ahead, gentlemen.
Thanks, Cynthia. Yeah, so we've gotten some questions in, but please don't hesitate to send some more. and if we don't get a chance to answer them, we can follow up after the fact as well. So, gotten a few questions on healthcare. So one way to summarize it from Rico, he asked, does healthcare perform better under the incumbent or the challenging candidate? And I'll summarize it another way. Another question was, you had the Obamacare slide, which looks like it may have contradicted how healthcare does. So Rob, could you explain your healthcare views in the election?
Sure. Yeah, let's see if I can go back to the slide where it shows healthcare's performance. Okay, so here is the slide. Healthcare has performed best on average when the incumbent party wins the election. And, the reason we kind of get to that is, there's less of a chance of big healthcare reform, big overhaul, because, the party's already been in control for years, and, likely the change won't be as big as if a new party's coming into power. And then under the Republican-Democrat question here, I think the next slide should have it if I can flip over to it. Here it is. So healthcare tended to perform better under Republicans and been weak under Democrats. But then, like I said towards the end of the presentation, under the Obama presidency, you saw the managed healthcare industry and healthcare sector really outperform. So I think the message is, in summary, that there could be more near-term headwinds for the sector. That's what history showed. You get a new president in there. Biden has his own healthcare plans. He wants to expand the ACA. He wants the public option. There's a lot of uncertainty with Biden winning the presidency, but longer term, his plan should lead to more healthcare insured, which should be a positive longer term. So one analog that we kind of point to is during the Obama presidency, you saw healthcare underperform for like a year and a half after Obama was elected. You saw the relative PE multiple contract from about 1.1 to 0.7. But then after the ACA passed, you had a few more months of weakness, but then you really had like 4 or 5 years of strong sector performance. So I think it could work out similar to that. Obviously, it won't be the exact same, but I think we could have some near-term headwinds, but I think longer-term, a Biden win is good for the sector, and it could be a good long-term investment for clients if Biden were to win the election.
Okay, thanks, Rob. Very helpful to put those things in perspective. So here's a quick question about a very good one that I probably should have mentioned up front. Chris asked about the sample size. There aren't too many cases of elections during some of our analyses here, and some of them go back, to a time when the markets were quite different. How do you account for this in your analysis, your confidence intervals? And the short answer is you need to look at all of this with that in mind, that you're not going to have a statistically significant answer to most of these. What you're trying to do is glean out trends and consistencies, and then go from there. We have quantitative models behind all of our recommendations. We're not going to say, hey, because of this election cycle chart, you should be all in stocks or all out of stocks. That's not how we would recommend using this. This is good, good information, background information that you can put into your broader analysis. We got lots of questions on taxes. So one of them, as I'll kind of try to phrase this from Daniel, and then in some others as well. So what would happen if the Democrats take control of the Senate and Biden wins? What would the timing be of any tax increases? And I think, first of all, yes, if the Democrats have control of the Senate, that would make all of Biden's initiatives more likely to go through. I think especially the tax side of things. I would also say I think the size of any majority would have a big impact. If it's a 51-49 situation, then there could be a few conservative Democrats that are coming up for reelection in Republican-leaning states that may not want to have that on the record. But if it's a 55-45 majority, it'd be harder for McConnell, whoever the Senate Minority Leader is, to pick off Democrats. I would also say, again, this is not historical analysis. This is just our looking at what Biden has been focused on. And you know, if you're going to try to prioritize his agenda, you know, there's COVID relief, there's expansion of Obamacare that Rob talked about, there's infrastructure spending, there's green energy, and then there's taxes. And even Schumer and some other Democrats in Congress have already implied that maybe 21 may not be the best year to do tax increases because the economy is still going to be recovering. So I'm not sure it's going to be a front and center thing. There's another question about making the taxes retroactive, that if you pass something late in 21 to capital gains tax increase, does that mean it's going to be effective for all of 21? The last two capital gains tax increases in 2013 and 1987 were not that way. 2013 actually was passed in 2010 as part of Obamacare, so it took almost 3 years for that to go into effect. And then the Tax Reform Act of 86 didn't go into effect until January of 87. So a lot of times tax cuts are retroactive, but at least if you go back the last 50 years, those tax increases generally aren't. Doesn't mean it can't happen this time. It doesn't mean there couldn't be some fear over that happening, and potentially there being some selling in late 2020 to make sure that you're paying a lower capital gains tax rate. That's possible, but again, that's not historically how they've done it. And considering both parties don't seem to be too concerned about deficits, I'm not sure they necessarily need to capture the gains in 21. But we'll have to see. But I think, yeah, it's a situation where the size of the Senate majority could have a long way to go in saying what gets passed and what doesn't. So we also got a good question on debt and deficits. What do we think that means for the broader economy and sectors? So it's not really necessarily about the election per se, but you know, what's going on now with COVID and the fact that neither party is all that interested in dealing with deficits. And you know, over the long run, higher debt is basically barring economic growth moving forward. So it just means it's going to be harder for economic growth in the long run. Over the short run, when interest rates are low, that's beneficial. But the question also asked about sectors. So Rob, do you have any antidotes, any thoughts on what the debt and deficits could mean for sector returns?
Yeah, I mean, just to expand on what you said a little bit, higher debt tends to lead to lower growth. So in slower growth environments, you know, it might be a little counterintuitive, but growth sectors tend to perform best in those environments. You might think high growth environments are good for high growth sectors. That's not really the case, because investors are willing to pay up for these big growth companies when growth is scarce. So I would say that, you know, more debt should lead to slower growth. We have a lot of charts that show that, and that would favor sectors like technology, discretionary communication services, and healthcare as well, that tend to be higher growth sectors.
Okay, great. Thanks. Yeah, we've gotten a couple questions on gold and the dollar, and in particular, you know, what does it mean, you know, post the election, and what does it mean, you know, based on who would win. And for the dollar, usually in the first year of the presidential cycle, the dollar, you know, can be strong early in the year, but then it's weaker later in the year. That's usually a reflection of the economy doing better in the election year, and then the economic growth starts to fade, and that's impacting things. But our view is that regardless of who wins, we think the dollar could be under pressure because the Fed is moving to be even more accommodative, and other major central banks have already pretty much gotten as accommodative as they're going to get. And so that's net negative for the dollar, and in turn net positive for gold. In that if interest rates are going to stay low, if governments aren't going to be concerned about debts and inflation is going to stay low, then those all tend to be overall good for the dollar. One way I think about it is one of the biggest knocks on gold is that it doesn't yield anything. You don't get a coupon like a bond. You don't get a dividend like a stock. It doesn't have earnings. But when interest rates are zero or negative, in some cases, the zero yield on gold doesn't look that bad. And so as long as that's going to be the case, which we think it's going to be for a while, then that's a positive for gold. And that leads to another question we got on inflation, where we alluded to in the presentation the huge government stimulus under LBJ, and the guns and butter policies. Now we've had even a bigger stimulus. Are we concerned about inflation? Short term, no, because there's so many global deflationary pressures when it comes to over supply, particularly in the manufacturing sector. Demographics are certainly working against us now, whereas in the 60s they weren't, with the baby boomers, starting to come into their spending years. Now they're leaving their spending years, and outside the U.S. it's even a bigger concern. We've seen that in Japan already. Germany is catching up quickly. Russia is already there as well. So the U.S. actually, relative to other countries, is demographically in pretty good shape. But globally, it's not at a point where we would expect there to be that surge in demand. So, but the amount of spending, is certainly at some point going to catch up to us. History is full of central banks, or even predecessors of central banks, engaged in these kind of activities that eventually does lead to problems in the financial system. My favorite story about that is way back in the Roman times. The emperor started shaving off metals to make the coin slightly smaller, but worth the same value. So that's quantitative easing circa year zero. So it's been going on for centuries, and usually doesn't end well. But that's not necessarily a concern over the short term. So Rob, we got a question on taxes in the real estate sector. So on slide 16, they mentioned that it looked like there wasn't much of a change in the real estate sector tax rate from 2017 and 19. So does that mean you don't expect many problems for real estate if taxes go up?
Let me see if I can find that slide real quick. So REITs, they pay out most of their earnings in the form of dividends. So they're, they don't pay as much taxes. So REITs, they're there it is. So there's not much change in REITs. They have special tax preference because of the fact that they pay out, like I said, all their a good portion of their taxes in the form of dividends. So they weren't impacted by the Trump tax cut. Only went down 0.2 percentage points. If taxes were to rise under Biden administration, I wouldn't anticipate. I would anticipate the effective rate to rise, but I wouldn't think it would be substantial enough to really impact our view on the sector at all.
Thanks, Rob.
Yep.
Yeah, so we got a question here from Chris about if Biden wins, how would that impact Chinese stocks? So the short answer is it probably would be somewhat of a net positive because it would be a cooling, likely somewhat of a cooling of the trade war. Although I would say that if you look at Biden's policies, they're not exactly China friendly. I think one of the consequences of the Trump presidency, whether he wins or loses, is that there's a rethinking of globalization and the impact on the U.S. manufacturing sector and the U.S. middle class. And certainly Biden, that's how he's trying to position himself. So I'm not sure that things would go completely back to normal, but I think more broadly you could get, it'd be a net positive for Chinese stocks. And you've started to see some relative strength out of emerging markets in China as of late, and that could have as much to do with the virus as it does the election. And we got time for one more, and this relates to technology. Thornton was asking about, what policies could impact the tech sector in view of regulations or anything else. So Rob, I'll kick that one over to you.
So it seems like tech is probably going to get more regulation regardless of who wins the election. Neither Trump or Biden have talked about breaking up these large mega cap tech companies specifically, but both support the antitrust investigations, and both have talked about getting rid of Section 230 of the Communication Decency Act, which basically provides platforms and internet companies liability against what's posted on their platforms or their websites. So the reasons why Trump and Biden want to get rid of Section 230 are completely different. Trump says that there's an anti-conservative bias on social media platforms, so he views platforms as basically policing too much. Biden says, there isn't enough policing and that these platforms need to be more responsible for the information that's on the platforms. So I think, in the U.S., we're going to get more tech regulation regardless who wins the election. It's kind of a trend that Europe has, kind of started. They kind of, been policing U.S. companies harder than the U.S. has. But yeah, I think, regardless of who wins, we're going to probably get more tech regulation in the coming 4 and 8 years.
Yeah, I think it's a really, really good point on that, Rob. And I think more broadly on the tech sector, it has become, and especially to expand the definition of tech beyond, say, the S&P GICS lineup. We have, how they define tech to include some of the, mega cap growth names that may be in communications or consumer discretionary. Those companies have done so well this year because their earnings have not been impacted nearly as much of the rest of the market. They've become a huge percentage of the market cap. And so there's potential for a rotation out of those names. Again, not really about the election per se, but as the economy reopens, and that could be something to keep in mind. And then you throw on some regulatory risk on there. That's something that we probably want to think about. Those are all risks, not necessarily saying what's going to happen right now, but those are risks, as we move into 21 to consider. So with that, thank you very much, everybody, for your time. Rob and I, really enjoyed this, but I'll pass it back over to Cynthia for any wrap-up comments.
Okay, well, Rob and Ed, thank you very much. Terrific presentation here today. And I know you've covered a lot of information, so I do want to remind everyone we have been recording today's event. If you want to come back and review any of the concepts that Rob or Ed went through in today's session, simply watch your inbox later on this afternoon for a direct link to today's recorded playback. By the way, I also want, if you do want a copy of today's slides, they'll be included included in our follow-up message later on this afternoon, but you can download a copy of those slides directly from the handouts panel over on the right-hand side of your screen. So with that, we are going to conclude our presentation here today. I want to thank all of you for your participation, and a special thanks to Ned Davis Research for bringing us today's webinar. By the way, keep in mind, Interactive Broker clients can access those research reports through the Trader Workstation. Simply go to the New Window button. You'll find Analyst Research, and you can locate NDR Research is available there, and you can access it directly through the platform. So with that, we will conclude our session here this afternoon. Have a great rest of your day, everyone. You can all exit using the X in the upper right-hand corner of your screen. Have a good one, all, and thank you so much.